Have you heard about debt consolidation and wondering if it's a good option for you? Well, what if I told you it could save you up to $1,000 or more every single month while protecting your credit and setting you up for success financially moving forward? In our lesson today, I want to talk to you about the power of debt consolidation and why I believe it's one of the best financial opportunities you have today, as well as some real-world examples from clients that I've helped with the strategies and how you can implement it into your situation right away.
Can you explain what debt consolidation is? And then we'll take it from there.
Okay. Debt consolidation is the process of paying off a bunch of loans. It could be 2 or 3, it could be 20, and replacing those loans with one new loan. So if you just look at the definition of the word consolidate, just in general, in all different industries, it's going to apply to debt. So we're talking about taking many loans and paying them off using one loan. So what does that do for you? We'll talk about the benefits, but it definitely simplifies things. And I think on the purpose, that's why a lot of people want to do it, is they say, well, I've got 5 payments. I got 2 credit cards, an auto loan, a mortgage, and a personal loan. Gosh, it would be so nice and it would be such a stress reliever if I could, instead of making 5 payments every month, I could make 1 payment. And that's really the surface of what debt consolidation is.
Hey, but why does debt consolidation get such a bad rap with a lot of financial advisors and even some of those money gurus?
I hear and I see it all the time. A lot of financial advisors will not advise debt consolidation. They'll say it's a bad idea. A lot of the money gurus like Dave Ramsey, Susie Orman, and the other financial pundits that you see on the news or here on the radio, they don't speak highly of debt consolidation. And the reason is because the majority of people that take these debt consolidation loans misuse them.
What you think the biggest mistake is that people make when they are consolidating their debt?
By far, the number one mistake that people make when consolidating their debt is letting the savings evaporate into their budget. Other big mistake, which ties in with that, is not having a financial plan in place.
Why is using a mortgage for debt consolidation such a great option?
Because the mortgage, by far, no matter what the interest rates are in the market, the mortgage is always going to be the lower interest rate. If a mortgage is at 6%, I guarantee you your credit cards are a lot higher. A personal loan is going to be a lot higher. The other thing is fixed cost. So on a mortgage, you can get like a fixed rate, whereas if you use a balance transfer credit card, for example, it might be 0% for 12 or 18 months. But what about after that? If you read the fine print, you'll see your credit card interest could go from 0 or 1.99 up to 20, 30, even more percentage points, and that's going to dramatically increase your monthly payment. It's going to dramatically increase the interest that you're paying, and it's going to undo all the good that you did when you consolidated or did that balance transfer. With a mortgage, it's a fixed cost.
Can you discuss using a personal loan for debt consolidation versus a mortgage?
Number one is there's no tax deductibility at all. Doesn't matter what you do or what your income is. There's no deductibility on a personal loan at all. The terms are very stringent. There's only 3 to 5 year options. The last reason why a personal loan is not as good as a debt consolidation mortgage is that the interest rates are going to be a lot higher.
Why is the timing so great right now for homeowners using equity to consolidate debt?
But the reason why the timing is so good right now versus 6 months ago, a year ago, or a couple years ago is that right now throughout the entire country, home values are very close or at their peak that they've ever been. So that means to you that as a consumer, someone looking to consolidate their debt, a homeowner with equity built up, you're going to be able to tap more equity today than you would have 6 months ago, than you would have a year ago. The next thing is that mortgage rates, although they've increased significantly over the last several months, they're still relatively low. They're still below the average over the last 30 years, which is about 6.5%. The other thing is that there's a lot of different options available for debt consolidation loans on your home. You've got the cash out refinance, but you've also got access to second mortgages. You've also got access to home equity lines of credit. While those have pros and cons that we've talked about on other episodes, it still is good to have options and be able to weigh different types of scenarios and different benefits to you when it comes to consolidating and which product is going to be best. My motivation in recording today's lesson was to give you some inspiration when it came to consolidating your debt and understanding that all the stigmas and the negativity out there about this is not all correct. If you found value in our lesson today, go ahead, hit the subscribe button. Also smash the bell so you get notified on all of our future content. And please share this lesson with somebody else who may be looking to consolidate their debt as well. If I can be of assistance to you or anyone that you know, I do offer consultations, so reach out to me via call, text, or private message. My direct line is 860-413-3938. As always, I hope that helps, and we'll see you soon.